Two of the most powerful research desks on Wall Street are looking at the exact same gold market right now, today, and they are nearly $1,500 apart on where it ends the year. Goldman Sachs says 4,900, JPMorgan says 6,000. That is not a rounding error between two banks. That is a fracture in how the smartest money in the world is reading the next 11 weeks. And if you own gold or silver, that fracture is either the most useful piece of information you will get all month, or it is something you scroll past without understanding what it actually means for your money. Before we go further, I want to ask you something. If two of the most resourced financial institutions on the planet, with access to data and models the rest of us will never see, cannot agree on whether gold is worth $4,900 or $6,000 by year end, what does that tell you about anyone, anywhere, claiming they know exactly where this market goes next? Hold that question in your mind, because by the end of this video, the answer is going to change how you think about every gold and silver headline you read between now and September. Here is where things actually stand today, the last trading day of June 2026. Gold is sitting just under $4,000 an ounce, down more than 10% for the month, and roughly 28% below its January all-time high, near $5,600. Silver is trading around $58, down more than 20% in June alone, and well off its own January record above $121. If you have been holding either metal through this stretch, you already know what the last few weeks have felt like. It has not felt like a structural bull market. It has felt like a slow bleed. And the reason matters more than the price action itself. The reason is the Federal Reserve, and specifically a man named Kevin Warsh. Warsh was sworn in as the 17th chair of the Federal Reserve in late May, after one of the most contested confirmation fights in the institution's history, narrowly approved by the Senate following months of political pressure on his predecessor. His first meeting running the Federal Open Market Committee came on June 17th, and what happened in that meeting is the single biggest reason gold and silver have been under pressure ever since. The committee held rates steady at 3.5% to 3.75%, unanimously. That part was expected. What was not fully priced in was the tone. 9 of the 18 officials who submit projections penciled in at least one rate hike before the end of this year. Warsh himself did not submit a dot, keeping his own hand close to his chest. But the committee, as a body, signaled something markets had not seriously prepared for since the inflation fight of the early 2020s. A hiking Federal Reserve, not a cutting one. But here's what most people covering this story are getting wrong, and it is worth pausing on before we go any further. They are treating the September FOMC meeting like it is a coin flip that has already mostly resolved itself. It has not. As of this week, Fed funds futures tracked by the CME FedWatch Tool put the odds of at least one rate hike by the September 15th and 16th meeting somewhere in the range of the high 50s to upper 60%, depending on which day you check. That is not certainty. That is closer to a 3 and 5 lean, with a real substantial chance the data between now and then pulls the committee back toward holding steady. And in that gap, in that uncertainty, sits the most important window in precious metals for the rest of this year. Let's talk about why the odds moved as much as they did, because the cascade started with a single data release. On June 25th, the Bureau of Economic Analysis published the Personal Consumption Expenditures Report for May, the inflation gauge the Fed actually targets, and the numbers were not good. Headline PCE came in at 4.1% year over year, the highest reading since April of 2023. Core PCE, which strips out food and energy, rose to 3.4%, the highest since October of 2023. Both numbers matched or came close to what economists expected, but matching expectations was the problem. It confirmed that the inflation surge driven by this year's conflict between the United States and Iran and the resulting disruption to oil flowing through the Strait of Hormuz has not yet started to unwind in the official data. Energy costs spiked when the conflict began in late February and early March. Brent crude, which traded in the mid-60s to mid-70s before the war, spiked above $120 a barrel at its worst point in late April. It has come down significantly since, into the high 80s and low 90s, but a ceasefire on paper has not translated into a clean reopening of shipping lanes. As recently as this past week, renewed strikes between American and Iranian forces around the strait pushed oil prices back up, even as both sides claim to be negotiating an extension of their fragile truce. That is the unresolved backdrop sitting underneath every inflation report between now and September. So what happens next? This is where preparation matters more than prediction, and where I want you to really pay attention, because the next 78 days contain a specific, dated sequence of releases that will each individually move the needle on whether the Fed actually hikes in September. The first one lands this week. The June jobs report, officially called the employment situation, is scheduled for release on Thursday, July 2nd. May's report was a shock to anyone expecting a cooling labor market. The economy added 172,000 jobs against a forecast of just 85,000, with unemployment holding at 4.3%. If June comes in anywhere close to that kind of strength, it adds fuel to the hawkish case heading into the Fed's July 28th and 29th meeting. If it comes in soft, well below expectations, it starts to chip away at the hike narrative before the Fed even has its July meeting. The next major release is June's Consumer Price Index, scheduled for July 14th. This is arguably the single most important data point of the summer for gold and silver, because it will be the first full month of CPI data reflecting whatever happens with oil prices through June. If energy costs continue easing from their wartime peak, headline inflation has real room to come down meaningfully from May's 4.2% reading. If oil stays elevated because the Strait of Hormuz situation remains unresolved, that disinflation story stalls out, and so does any case for the Fed backing away from a hike. Then comes the July 28th and 29th FOMC meeting itself, Chair Warsh's second meeting at the helm. Watch the language in that statement closely. Any softening from the hawkish tone set in June, any hint that the committee views the energy-driven inflation as temporary rather than structural, would be a meaningful signal that September is less locked in than current pricing suggests. But here is the part most coverage of this story is ignoring completely, and it is the part that actually matters for anyone thinking in years rather than weeks. While traders are obsessing over a quarter-point rate decision, the structural buyers of gold have not stopped buying, and they are not watching the Fed funds futures market to decide whether to keep going. The World Gold Council released its annual Central Bank Gold Reserve Survey this June, polling 76 central banks, the highest participation in the survey's 9-year history. 89% of respondents said they expect total global central bank gold holdings to keep rising over the next 12 months. A record 45% said their own institution plans to add gold. Central banks have been buying gold at roughly 1,000 tons a year for the past 4 years, double the pace of the decade before that. And according to the World Gold Council, gold has now actually surpassed U.S. Treasuries to become the single largest reserve asset held by central banks globally. That is not a headline that gets nearly enough attention, and it tells you something the rate hike debate cannot. The institutions that move on multi-decade time horizons are not selling into this correction. They are using it. If you've been finding this kind of grounded, data-first breakdown useful, this is exactly the kind of analysis this channel is built around, separating the noise from what actually moves these markets over time. Subscribing helps more people find this kind of preparation instead of the panic headlines that dominate most financial coverage, and it genuinely helps keep this research going. Now let's get back into what the next 2.5 months actually look like, because there is a lot more to unpack. Let's talk about silver specifically, because the story underneath the price action is, if anything, more compelling than gold's right now. The Silver Institute's World Silver Survey, published this past April in partnership with the research firm Metals Focus, projected that 2026 will mark the 6th consecutive year in which global silver demand exceeds global supply. The shortfall is forecast at 46.3 million ounces, wider than last year's 40.3 million ounce deficit. Since 2021, the market has drawn down a cumulative 762 million ounces from above-ground stockpiles just to bridge that gap. That is not a sustainable trend indefinitely, and it has nothing to do with what the Fed does in September. Here is the detail that should genuinely surprise you. The same Silver Institute report, published while silver was already deep into its correction from January's highs, forecast that Western physical investment demand, meaning coin and bar purchases, would rise 20% in 2026 to 227 million ounces, a 3-year high, reversing 3 straight years of decline. In other words, the most authoritative research body covering physical silver supply and demand looked at this exact environment: falling prices, rate hike anxiety, geopolitical uncertainty, and projected that retail investors would step in and buy more, not less. That tells you something about who tends to be accumulating during corrections like this one, and it is rarely the people reading the scariest headline of the week. The gold-to-silver ratio is also worth watching closely through this window. It has been sitting in the high 60s recently, well above its long-run historical average, which simply means silver has gotten cheaper relative to gold than it typically trades. In a hawkish scenario, where the Fed actually does hike in September, it would not be surprising to see that ratio push higher still before it reverses, as silver tends to take the harder hit during paper market sell-offs tied to rate fears. But ratios at extended levels have historically been the setup for sharp reversion once the rate picture clarifies, not a permanent new normal. Now let's talk honestly about the floor underneath gold, because the old assumption that mining costs sit somewhere around $300 or $400 an ounce is badly out of date. Industry data from S&P Global's most recent mine cost outlook puts the median all-in sustaining cost for gold producers somewhere between $1,500 and $1,800 an ounce today, with input costs, labor, energy, and sustaining capital all having risen sharply over the past several years. Even so, with gold trading near $4,000, that still leaves the average producer with an operating margin in the range of $2,000 an ounce or more, among the widest in the history of the industry. That margin is exactly why mine supply has not meaningfully responded to this correction, and why most analysts do not see this pullback as the kind of move that threatens gold's longer-term structural support, even though it has clearly tested investor patience. So where does that leave the bank forecasts and that $1,500 gap between Goldman and JPMorgan we opened with? It is worth understanding exactly why they disagree, because it is not a difference in data. It is a difference in how each bank weights the rate path. Goldman's model leans heavily on expected Fed easing, and when the bank pulled every projected 2026 rate cut out of its forecast following Warsh's hawkish June meeting, its gold target dropped by $500 almost mechanically, down to $4,900, with an explicit downside case near $4,400 if the Fed actually does hike. JPMorgan's model leans more heavily on the structural side, central bank demand, fiscal deficits, and de-dollarization, and has held its $6,000 year-end target through the correction, alongside a stated floor near $4,300. Wells Fargo's Investment Institute is even more bullish, projecting somewhere between $6,100 and $6,300 by year-end. Bank of America's base case sits closer to $6,000 as well, with an acknowledged, more extreme scenario reaching $8,000 if de-dollarization accelerates sharply. None of these are guarantees, and none of these institutions would claim they are. But notice what the spread is actually telling you. It is not that gold's bull case is broken. It is that the rate path between now and year-end is genuinely the single biggest swing factor left in the model, more than central bank demand, more than the fiscal backdrop, more than anything else analysts are tracking right now. So let's walk through what each realistic outcome between now and September 16th actually means for your position, because this is the part that matters more than any single forecast. In a scenario where the data keeps validating the hawkish case, strong June and July jobs numbers, inflation that stays sticky in the high 3s or low 4s because the Strait of Hormuz situation remains unresolved, you could reasonably expect gold to retest and potentially break below 4,000, and silver to come under renewed pressure toward the mid-50s. That would be an uncomfortable stretch. It would dominate financial headlines, and it would be the moment when conviction gets tested hardest. But it would not, on its own, undo the structural deficit in silver or the central bank buying underneath gold. Those forces operate on a different timeline than a single quarter-point decision. In a scenario where June and July data softens meaningfully, jobs growth slows, and oil's decline finally shows up cleanly in the CPI and PCE reports, the case for a September hike could fade quickly, potentially back towards something closer to even odds or lower. That is historically the kind of environment where gold and silver have found their footing and started to rebuild, as real yields compress and the opportunity cost of holding non-yielding metal eases. And in the most statistically likely scenario, something in between, mixed data, a Fed that stays genuinely undecided right up until the September meeting itself, expect continued range-bound, choppy trading in both metals. That is not the same as a broken thesis. Range-bound markets sitting above structurally significant levels, with deficits and central bank demand still running underneath, are often simply absorbing uncertainty rather than reflecting it. There is another layer to this that almost nobody talks about, because it does not show up cleanly in daily price charts. Positioning. Futures markets and physical markets do not always move together in the short term. During periods of uncertainty like this, paper positioning can unwind extremely quickly, while underlying physical demand changes much more slowly. That distinction matters because corrections often feel more dramatic than the actual shift in long-term ownership. If traders reduce leveraged exposure into a possible September hike, prices can move sharply even while long-horizon buyers continue accumulating underneath the surface. Historically, those moments have been uncomfortable to sit through, but important to understand, because volatility and structural demand are not always telling the same story at the same time. And there is one final psychological trap worth paying attention to over the next 11 weeks. Markets have a way of making the largest number of people uncomfortable right before uncertainty resolves. If gold suddenly rallies into July, people will worry they missed the bottom. If it drops again, people will question whether the entire thesis has failed. But neither reaction changes the underlying process. The market does not care whether expectations feel reasonable. It responds to incoming data, liquidity, positioning, and confidence. That is why watching dates, probabilities, and confirmed releases matters more than watching emotional reactions online. Between now and September, the goal is not predicting every move. It is understanding which information actually changes the story and which information only changes the mood. There is another reason this period may feel unusually difficult for investors compared with previous corrections, and it comes down to expectations. Gold and silver are not coming into this period from depressed levels. They are coming into it after one of the strongest runs in modern market history. That matters because corrections after euphoric moves tend to feel disproportionately painful, even when prices remain historically elevated. Gold near $4,000 is not historically cheap. Silver near the high 50s is not historically depressed. But human psychology does not compare today's price to 10 years ago. It compares today's price to the recent peak. That difference between objective price and emotional reference point explains why markets can feel worse than they actually are. There is also a timing mismatch happening right now that deserves more attention. The market moves immediately. The economy does not. Energy shocks, inflation pressures, interest rate expectations, corporate decisions, consumer behavior, those things move on completely different clocks. Oil can spike in a week. Inflation data can take months to reflect it. Central bank policy can take even longer to transmit through the real economy. Investors often expect instant confirmation that a narrative is correct, but markets rarely operate that way. What we may be watching right now is not the final destination of inflation or metals pricing. We may simply be watching the lag between events and the official data catching up. Another overlooked piece of this puzzle is the US dollar itself. Precious metals are often discussed as if they only react to rates, but currencies matter just as much. A stronger dollar can create pressure on gold and silver, even if the long-term thesis remains intact, because commodities priced globally in dollars become more expensive for buyers outside the United States. But currencies move in cycles too. If markets begin pricing fewer hikes than currently expected, or if growth begins slowing faster than anticipated later this year, dollar strength can reverse surprisingly quickly. That is one reason why short-term price weakness and long-term structural demand can exist at the same time without contradicting each other. Something else worth remembering is that markets rarely ring a bell at turning points. If September arrives and the Fed hikes, there probably will not be a headline saying the correction is over. If the Fed pauses, there probably will not be a clean signal either. Major shifts usually look messy in real time. They happen through lower volatility, improving sentiment, stabilization and positioning, and slowly changing expectations before the price move becomes obvious to everyone. Looking back, turning points often seem inevitable. Living through them usually feels uncertain and frustrating. And that brings us back to the original question we started with. If institutions with enormous research budgets and access to world-class models can disagree by nearly $1,500 on the same asset over the same time horizon, maybe the lesson is not that someone knows the answer and someone else does not. Maybe the lesson is that uncertainty itself is the dominant variable right now. The goal is not to eliminate uncertainty. It is to understand it better than the average participant. Because when markets finally choose a direction, the people who tend to benefit are usually not the ones who predicted perfectly. They are the ones who stayed focused on the right variables, while everyone else got distracted by the noise. One pattern worth knowing, stated carefully, because nothing here is a guarantee. Historically, when a Federal Reserve hiking cycle has reached its final move and then paused, that pause has often marked an inflection point for precious metals, rather than a continuation of weakness, since a Fed that stops hiking removes the primary headwind weighing on non-yielding assets. That has played out in some previous cycles. It is not a law of markets, and this cycle has its own unique drivers, including a geopolitical conflict still working its way through energy markets. But it is a historical pattern worth knowing as you think through how a September hike, if it happens, might fit into a longer arc rather than functioning as the final word. What ties all of this together is something analysts at Macquarie pointed out in a research note this past week, when they suggested that gold's recent retreat reflects fading safe haven appeal alongside a more hawkish Fed and a stronger dollar, and that a genuine catalyst would likely be needed to reignite sustained upside interest. That catalyst does not have to be a single dramatic event. It could be the June CPI report on July 14th coming in meaningfully below expectations. It could be a Fed statement on July 29th that quietly drops the hawkish language from June. It could simply be the slow accumulation of central bank purchases and a widening physical silver deficit finally outweighing rate-driven selling. None of those outcomes are guaranteed, and none of this is a recommendation to take any specific action with your own money. But understanding the actual calendar, the actual data points, and the actual range of realistic outcomes between today and September 16th puts you in a meaningfully different position than reacting to whichever headline is loudest on any given morning. So here's what I want you to walk away with. The next 11 weeks are not a referendum on whether gold and silver's longer-term case is right or wrong. They are a stress test of conviction during a period of genuine, two-sided uncertainty, the kind reflected by the fact that two of the most sophisticated research operations in finance are nearly $1,500 apart on the same asset. The data calendar, the jobs report this week, June CPI in mid-July, the Fed meeting in late July, gives you specific dates to watch rather than vague anxiety to sit with. I want to leave you with a real question, not a price prediction. When the June CPI report lands on July 14th, what number do you think we see, and what do you think it does to the odds of a September hike? Put your specific number in the comments, headline and core, and your reasoning behind it. In 2 weeks, we will know who actually understood what was driving this market and who was just reacting to the noise. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.